If you've ever heard the story of 1929, you've probably heard the same version everyone hears. Stock prices got too high. People panicked, the market crashed, and the Great Depression followed. That version isn't wrong, but it's incomplete. And the parts left out are the parts that actually explain why the crash happened when it did, why it hit as hard as it did, and why it turned into a decade-long catastrophe instead of a bad month for rich investors. Before we go further, if you want more of these deep, fact-based dives into the real economic forces hiding behind the headlines of history, hit subscribe and give this video a like. It genuinely helps this channel keep making them. Now, let's get into the real story, the one buried underneath the textbook version, the one involving a secretive network of pyramid-shaped holding companies, a central bank that made a catastrophic policy decision most people have never heard of, and an income gap so extreme that the entire boom of the 1920s was, in a very real sense, standing on a foundation that was already cracking years before Black Tuesday ever arrived. This is Economy Rewind history. This is what actually caused the crash of 1929. Let's start with the piece of this story that almost never makes it into the popular retelling. The Federal Reserve's own policy decisions in the years directly leading up to the crash. Modern economists, including Nobel laureate Milton Friedman and his collaborator Anna Schwartz, argued in their landmark monetary history of the United States that those decisions were far more central to the disaster than simple stock market speculation alone. Throughout the mid-1920s, the Federal Reserve kept interest rates relatively low, partly as a favor to Britain, which was struggling to maintain its own currency's value after returning to a pre-war gold standard that many economists privately worried was fundamentally unsustainable. This cheap money flowed directly into the American stock market, fueling exactly the kind of speculative borrowing that inflated stock prices far beyond what company earnings could justify. Then, starting in 1928, alarmed by the speculative frenzy it had partly enabled, the Federal Reserve reversed course and began aggressively raising interest rates, tightening credit sharply. And it did that at the exact moment the broader American economy, outside of Wall Street, was already beginning to slow down. This is the detail almost nobody discusses. The Federal Reserve was trying to cool down a stock market bubble while accidentally choking off credit to ordinary businesses and farmers who had nothing to do with Wall Street speculation. It was a blunt, poorly calibrated instrument that helped turn a market correction into a systemic credit crisis. Friedman and Schwartz's research goes even further, arguing that the Fed's most catastrophic failure wasn't actually its actions before the crash, but its passivity afterward. The money supply contracted by roughly a third between 1929 and 1933 as banks failed one after another, even though the Fed had tools that could have limited that contraction and chose not to use them fully. That failure helped turn what could have been a serious but contained recession into the Great Depression itself. Now let's talk about a piece of this story that has almost entirely vanished from popular memory, despite being, according to many financial historians, one of the single most dangerous structural forces feeding the 1920s bubble: investment trusts, and specifically pyramid-shaped utility holding companies. Throughout the late 1920s, thousands of investment trusts were created, essentially companies whose entire business model was buying stock in other companies and then selling shares of themselves to the public. They promised ordinary investors access to professionally managed, diversified portfolios. That sounds harmless, even reasonable, until you understand how aggressively leveraged many of these structures became. Some investment trusts didn't just buy stock in operating companies. They bought stock in other investment trusts, which had themselves bought stock in yet another layer of investment trusts. The result was a towering, multi-level pyramid of borrowed money stacked on top of borrowed money, where a relatively small decline in the value of the real businesses at the bottom could wipe out the inflated value of every layer stacked above them. The most infamous example was the business empire built by Samuel Insull, a former secretary to Thomas Edison, who became one of the most powerful utility magnates in America. He controlled electric and gas companies serving millions of customers across multiple states, through an almost incomprehensibly complex web of holding companies stacked on top of holding companies, each layer borrowed against the value of the layer beneath it. When the crash hit, Insull's entire empire collapsed within about 2 years. And it collapsed not because the underlying utility businesses had stopped working, because they continued providing electricity and gas exactly as before. It collapsed because the empire itself had been built on a pyramid of debt. Roughly 600,000 ordinary investors and bondholders lost their savings, many of them people who had trusted Insull's companies precisely because they seemed so large and so established. This is a critical, underappreciated detail. Much of the wealth destroyed in the crash and its aftermath wasn't destroyed because the underlying American economy, its factories, utilities, and real productive capacity had suddenly become worthless. It was destroyed because that real economic value had been artificially multiplied many times over through leveraged financial structures that had almost nothing to do with the value of the businesses underneath them. And when confidence broke, those structures collapsed far faster and far more completely than the real economy beneath them ever did. There's a third piece of this story that deserves far more attention than it typically receives. The staggering, historically extreme level of income and wealth inequality that defined the entire decade leading up to the crash. Economists studying the Depression, including Mariner Eccles, who would later become chairman of the Federal Reserve under President Roosevelt, argued that this inequality was a root structural cause of the crisis, not simply an unrelated social issue happening alongside it. By 1929, the wealthiest 1% of Americans held roughly a quarter of the nation's total income, and the top 10% held nearly half, levels of concentration that wouldn't be matched again until the early 21st century. Eccles later argued that this concentration of wealth was economically destabilizing in a very specific, mechanical way. When such a disproportionate share of national income flows to a small number of extremely wealthy households, those households cannot possibly spend all of it on ordinary consumption, buying groceries, clothing, and household goods, the way a broader, more evenly distributed income base would. Instead, that concentrated wealth increasingly flowed into financial speculation, into the stock market, and into exactly the kind of leveraged investment trusts described a moment ago. That pushed asset prices higher and higher, while the actual purchasing power of ordinary working American families stagnated or grew only modestly throughout the decade. Meanwhile, American farmers, who made up roughly a quarter of the entire workforce at the time, had already been suffering through a prolonged agricultural depression throughout most of the 1920s. That crisis was driven by overproduction, falling crop prices, and crushing debt burdens taken on to buy land and equipment during the temporary wartime boom in agricultural exports. That meant a significant share of the American population was already in genuine economic distress, years before Wall Street ever noticed anything was wrong. This created a deeply lopsided economy, a stock market roaring to record highs, built substantially on borrowed money and speculative leverage, sitting directly on top of a broader economic foundation where farmers were going bankrupt, where wage growth for ordinary industrial workers had failed to keep pace with soaring corporate profits and productivity gains, and where consumer spending, once the initial post-World War I buying boom faded, increasingly depended on installment credit, an early version of buy now, pay later financing, rather than genuine, sustainable growth in real household income. Put these three underappreciated forces together, and a genuinely different picture of 1929 emerges, one that goes well beyond the simple textbook story of overexcited investors buying too much stock. The Federal Reserve's policy whiplash, first fueling speculative borrowing with cheap credit, then abruptly tightening at precisely the wrong moment, created the monetary conditions for a sudden, sharp credit contraction. The pyramid-shaped investment trusts and holding companies epitomized by empires like Samuel Insull's meant that once confidence broke, the actual financial damage would be dramatically amplified far beyond what any decline in real underlying business value could explain on its own. That happened because so much of the market's paper value existed only as leveraged bets stacked on top of other leveraged bets. And the extreme concentration of income and wealth throughout the decade meant the broader American economy was already far more fragile and far more dependent on unsustainable borrowing to sustain ordinary consumer spending than the booming stock market headlines of the era ever suggested. When Black Thursday and Black Tuesday finally arrived in late October of 1929, they weren't simply moments when investors got scared. They were the moment all three of these underlying structural weaknesses collided simultaneously: poorly calibrated monetary policy, dangerously leveraged financial pyramids, and an economy dependent on unsustainable borrowing to paper over deep income inequality. And each one made the other two significantly worse. This matters enormously for understanding what actually turned a stock market crash into the Great Depression, because the crash itself, as devastating as it was, wasn't automatically destined to become a decade-long global catastrophe. That outcome required the additional layer of policy failures that followed. As banks began failing across the country in 1930 and 1931, roughly 9,000 of them would ultimately collapse before the crisis ended. There was no government deposit insurance protecting ordinary American savings, which meant each individual bank failure wiped out the life savings of everyday depositors who had never touched a single share of stock. And every failure made surviving banks more cautious and less willing to lend, deepening the credit contraction the Federal Reserve had already set in motion and, according to Friedman and Schwartz's research, largely failed to counteract. In 1930, seeking to protect struggling American industries and farmers, Congress passed the Smoot-Hawley Tariff Act, dramatically raising taxes on imported goods. Rather than protecting the American economy, the law triggered a wave of retaliatory tariffs from other nations and helped strangle international trade at precisely the moment the global economy most needed cooperation rather than isolation. And because the international financial system of the era remained tightly bound together by the gold standard. The same rigid monetary system that had partly caused the Federal Reserve's problematic interest rate decisions in the first place, the American banking collapse transmitted itself directly into European economies. Germany was hit especially hard because it was still struggling under the weight of World War I reparations payments and remained heavily dependent on American loans to keep its own economy functioning. This is precisely why economic historians widely connect the Great Depression to the rise of political extremism in Germany during the early 1930s, an economic catastrophe originating substantially in American monetary policy and financial structure ended up reshaping the political fate of nations an ocean away. So why doesn't this fuller, more structurally complete version of the story get told as often as the simple narrative of investor panic and market euphoria? Part of the answer is genuinely mundane rather than conspiratorial. Monetary policy mechanics, pyramid-shaped holding company structures, and long-run inequality statistics are simply harder to explain in a compelling, dramatic way than describing a trading floor full of screaming, panicking men watching their fortunes vanish in real time. Popular history, whether in documentaries, movies, or casual retellings, naturally gravitates toward the version of events that's easiest to visualize and easiest to feel emotionally, not necessarily the version that's most structurally complete. Part of the answer is also that Friedman and Schwartz's specific argument about Federal Reserve policy failure wasn't published until 1963, more than 3 decades after the crash itself. That meant an entire generation of Americans grew up with only the simpler, earlier narrative before economists had fully mapped out the monetary policy dimension of the crisis. None of this requires any secret cover-up or deliberate suppression to explain. It simply reflects how complicated economic history gets simplified, generation after generation, into whichever version of the story is easiest to tell and easiest to remember, even when that simplified version leaves out some of the most important and instructive lessons buried inside the full historical record. There's a fourth piece of this puzzle worth adding, because it explains the actual mechanical process by which the crash fed on itself once it began, something that goes beyond simply saying investors panicked. Throughout the late 1920s, an investor could purchase stock by putting down as little as 10% of its value in cash and borrowing the remaining 90% from a broker, a practice called buying on margin. Brokers obtained the capital to fund these loans largely through something called call loans, short-term loans from banks, and increasingly throughout the decade, from ordinary corporations that had nothing to do with Wall Street. Those corporations discovered they could earn a far higher return lending spare cash into the call loan market than through almost any other legitimate business use of that same money. By 1929, non-financial corporations were supplying well over half of all outstanding broker loans, meaning a huge share of the speculative bubble was being financed by industrial and commercial companies, quietly redirecting their own working capital into stock market speculation because the returns were too attractive to pass up. Call loans carried one especially dangerous feature. They could be recalled on demand. A lender could require full repayment virtually overnight the moment it grew nervous, which is exactly what began happening as the market wobbled in October of 1929. As lenders across the call loan market simultaneously lost confidence and demanded repayment, brokers were forced to require margin investors to either post additional cash immediately or have their stock automatically liquidated to cover the debt. That mechanism, now known as a margin call, dumped even more shares onto an already falling market, accelerating the very price decline everyone was scrambling to escape. This detail matters enormously because it means the crash wasn't simply a story of investors deciding to sell out of fear. It was a mechanical, self-reinforcing cascade built directly into the leveraged architecture, financing the entire boom. Falling prices automatically triggered forced selling, which caused prices to fall further, which triggered still more forced selling. It was a feedback loop that had almost nothing to do with whether the underlying companies being dumped were actually worth less than they had been the week before. There's also an international thread to this story that almost never makes it into the American classroom version of events, but financial historians increasingly treat it as a genuinely important hidden connection between Wall Street's boom and the fragile web of post-war international debt. Following World War I, Germany owed massive reparations payments to Britain and France, while Britain and France, in turn, owed substantial war debts to the United States. This entire arrangement was held together throughout the 1920s, largely by a continuous flow of American private loans into Germany, structured initially under an arrangement called the Dawes Plan. American investors were effectively lending Germany the money it needed to pay reparations to Britain and France, who then used part of those reparations to repay their own war debts to the United States. It was an almost circular financing loop that functioned reasonably well, only as long as American capital continued flowing outward into Europe. As the American stock market boom accelerated through 1928 and 1929, American investors increasingly redirected their capital away from these lower-yielding international loans and toward the more exciting, higher-return world of domestic stock speculation. That shift quietly starved the German economy of the capital it depended on to keep its reparations and reconstruction obligations functioning. When American lending to Germany slowed sharply and then reversed entirely after the crash as American investors urgently needed cash at home, the already weakened German banking system was pushed toward its own severe crisis by 1931. That crisis then spread further instability across the interconnected European financial system. In other words, the same speculative mania pulling capital into Wall Street was simultaneously starving the fragile post-war European economy of the money it needed to remain solvent. The crash wasn't simply an American story that later spread abroad. From very early on, it was a genuinely interconnected global financial event, with American speculation and European fragility feeding directly into one another well before October of 1929 ever arrived. And those lessons remain genuinely urgent, because every structural weakness that made 1929 so catastrophic has a direct, recognizable echo in modern financial history and in the financial system you live inside today. Central bank policy whiplash, cheap money followed by abrupt tightening, remains a genuine risk factor economists watch closely in every modern economic cycle, including the rapid interest rate increases of 2022 and 2023 undertaken specifically to fight post-pandemic inflation. Highly leveraged financial structures, where the value of one investment depends entirely on the value of other similarly leveraged investments, echoed clearly through the complex mortgage-backed securities and collateralized debt obligations that helped trigger the 2008 financial crisis. Those instruments were modern descendants of the same kind of pyramided risk that destroyed Samuel Insull's empire in 1932. And the question of whether extreme concentration of income and wealth creates genuine, measurable economic fragility, rather than simply being a separate social or moral concern, remains one of the most actively debated questions in economics today. It is still being studied by current Federal Reserve researchers, examining the same kind of dynamics Mariner Eccles first pointed to nearly a century ago. So the real reason behind the 1929 crash was never really a secret deliberately hidden from the public. It's simply a more complicated, less cinematic story than the version most people have heard, built not around one single moment of panic on a trading floor, but around years of accumulating structural fragility, poorly calibrated monetary policy, dangerously leveraged financial pyramids hiding beneath a booming stock market, and an economy where the gains of an entire decade of growth had concentrated so heavily at the very top that the broader foundation underneath it was already cracking long before anyone on Wall Street noticed. Understanding that fuller version doesn't just help you understand 1929 more accurately. It gives you a genuinely useful lens for recognizing the exact same warning signs the next time they begin quietly accumulating inside a modern economy. If this deeper dive into what actually happened in 1929 gave you a new way of looking at financial history, make sure you're subscribed to Economy Rewind History so you don't miss the next one. And if you found this valuable, drop a like. It makes a real difference in helping this channel continue telling the fuller version of these stories.